Joining us right now is Jeff Currie. He's Goldman Sachs Global Head of Commodity Strategy. And Jeff, we've been talking for a long time about how these are some serious issues with supply, issues we haven't seen in a very long time. I know a lot of people have been calling for much higher oil prices, but the other side of that has to be the demand picture. And with what we heard from China overnight, an anticipation of 5% growth, great compared to anybody else, but low relative to what we've expected from China. What does that mean for energy prices and other commodities in the near term?
Well, I think we had already embedded 5% with no real significant additional stimulus. Because think about the reversal of zero COVID policy has really created a growth impulse inside China. It was evident in the PMIs last week that showed, factory activity at the highest level since 2012. So we're not worried about that. All the evidence coming out of China points to a stronger China. But I like to say there's a macro stalemate going on right now. On one side, you have a strong China. The other side, you have a persistent Fed. And between all of that, you have impatient capital. And as a result, positioning is quite low. Commodities are flat year to date. And we haven't seen that strength in China materialize into higher oil, energy, or even metal prices right now. And right now, the market is just sitting on bated breath, waiting for evidence of inventory declines and tightness to begin to materialize. Right now is the weakest period seasonally for demand, but by June, we think you're going to start to see that evidence of tightening fundamentals, which is going to push prices higher and out of this recent trading range and, push it up towards, 90, 95. And, our target by fourth quarter is $100 a barrel.
Wow. That's because of China writ large, the economy opening up there, maybe an economic slowdown not really materializing here. How do all of these economic things play in just with the United States?
Well, I think the economic data has been too good. Too much of a good thing that has created concerns of a persistent Fed that's going to go further for longer, and that'll put a cap on commodity prices. I think the reason why positioning is running a 2 to 3 out of 10 in terms of length is that they're very concerned that if oil prices pop, the Fed is going to be more persistent and put a lid on it like what we saw last year. Our economists, however, believe that core CPI will relatively remain benign. It's more of an accounting that they come up with that, which means you do have some room for oil to rally, which is why once we see the evidence of inventory draws, our estimates put it at June, this market's likely to start to move higher. By the way, though, it was IP week here in London last week, and we got a feel for everybody's views. The one takeaway I had was everybody shared the same view, a tightening market beginning at the end of 2Q into the second half of next year. So the question is, when does the market try to price it in? And I think that persistent Fed has people unwilling to put the trade on now, which is why positioning is so light. And
so this is all based around the Fed, too, just like everything else we watch in the markets, that if they push it too far.
Last year was very painful across the commodity markets, particularly during third quarter when you saw the Fed aggressively reduce liquidity out of the system. And in fact, I like to raise the question during that time period, what dollar-denominated asset went up? I've asked that to many clients, and the only one they can point to is steel, a very localized micro market. But I think the key point there is that's what's keeping people on the sidelines. And the sidelines is the crowded trade right now.